address external imbalances. In the last 2 years, actually, growth in Croatia has surprised on the upside. The economy is growing much faster than we had expected, and much faster than our estimates of potential growth. This is not sustainable unless there are very deep structural reforms. And the external vulnerabilities that there are in many countries in emerging Europe are very much a concern here. This means that we need more ambitious fiscal consolidation. And this is not as difficult in Croatia. First, because Croatia is a big spender. Croatia spends as a share of the general government spending in Croatia as a share of GDP is 10% higher than the average in other transition economies in Europe. And in addition to that, this is not difficult because the revenue performance is very good, primarily because the economy is growing faster than potential. And the revenue performance has been much better than in the budget. Under these conditions, if you just keep the spending at the budget level and you save the extra revenues, right away you have a much lower deficit. At the same time, it is important to continue steps to strengthen financial sector supervision, and progress has taken place in this area. The central bank has strengthened financial sector supervision. A non-bank financial sector supervisor, HANFA, has been created, and steps in this direction should continue because, as we saw in the US subprime crisis, when there is fast credit growth, usually this goes hand in hand with excesses and exuberance that may create trouble on the way. But at the end of the day, structural reforms are needed to increase potential growth and improve competitiveness. And this is an area that different indicators show that Croatia lags other similar economies in Europe and outside Europe. It needs more reforms that will reduce the role of the state in the economy, create a friendlier business environment, and attract more foreign direct investment. Part of the growth performance in the Baltics and Central Eastern Europe, with Southeastern Europe, including Croatia, has been that the first has attracted much more foreign direct investment of the greenfield kind, greenfield FDI, and outside the financial sector. And finally, the IMF has supported the current monetary policy framework. Given that this is a euroized, small open economy, basically there aren't many choices for the central bank other than to focus on exchange rate stability. But given that the central bank can only have a supportive role, it needs support from other policies. The leading role should be on fiscal policies and structural reforms. And with this, let me briefly summarize the analytical chapters of our report and what are the main conclusions. The first chapter focuses on financial systems in advanced European economies, and the main results can be summarized in this chart. We look at the evolution of three indicators: traditional banking intermediation, capital market development, and new financial intermediation, financial innovation, and how this evolved in the last 10 years, from 1995 to 2004, for which we have available data. And what you see in advanced European economies is that almost in all countries, these indicators show that financial sector developed considerably in the last 10 years in Europe. The second thing you see is that the picture is very mixed. Some countries have progressed much faster than others, and some countries are further ahead than others. And you also see that compared to systems in the United States, Europe still has a long way to go. In our report, we are discussing a few country cases. We are discussing the case of Italy, where the financial system is not very much developed, it's somewhere in the middle, but in these 10 years it showed significant progress. We are discussing the reform that took place, and we are discussing evidence that this movement of the financial system away from traditional and relationship-based financing that was the case was not a negative development for small enterprises, which was one of the concerns in Italy. We are also discussing the case of Denmark, where financial innovation and a more sophisticated financial system in recent years has channeled resources towards high value-added activities and fast-growing companies compared to the past. But basically, as you see, most of the advanced European economies still have a long way to develop the financial system, primarily the non-bank financial system, and this is one of the reasons why financial innovation is a process that should continue on the way ahead. The next chapters discuss the case of emerging Europe, and here you see something that I pointed out earlier, that there was and still is very fast credit expansion in emerging Europe. Here you see the stock of credit to non-financial corporations and households as a share of GDP. And throughout emerging Europe, this has increased very fast. The increase over the last 6 years is shown in this column. And if you look at this column at where this ratio stands at the end of 2006, we see that this has increased a lot, but compared to the advanced European economies, it still has a long way to go. In the euro area, this ratio is 135%. So we expect that at least in the medium term, fast credit growth in emerging Europe will continue. Outside the banking sector, developments have been much slower. And here we look at outstanding debt security in financial institutions, corporations, and government. And we see that in most of emerging European economies, these are still at infant levels, much lower. The chapter emphasizes particularly the importance to develop a market in government debt, because this involves infrastructure improvements and institutional reforms that can have positive spillovers in the rest of the financial sector. And we're discussing the case of Hungary, where successful reforms have set up such a market, and you can see the result here. But also the case of Ukraine, where a number of efforts in the past have not really succeeded. Stock markets in emerging Europe also have significant room to develop. In terms of capitalization and turnover, they are way behind advanced economies or the euro area or even emerging economies in Asia and in Latin America. What we see in emerging Europe is that most of the times the stock markets are dominated by large companies and there is no high liquidity. So this is another area that as the financial sector develops further, we will expect that the stock markets will also develop further and will become a more important source of finance of private sector investment. The second chapter in the report looks at the different stages of convergence, and it estimates a macroeconomic model, and it finds basically that there are two stages. There is a first stage, the expansion stage, where emerging Europe is today, in which countries borrow, there is credit expansion, there is strong domestic demand, expecting a productivity increase in the future. And at this stage, you have an increase of production of non-tradable goods, and you have high imports of tradables, and you have a very high current account deficit. In the second stage, this is a stage that economies need to adjust, resources need to move to the tradable sector, and debt needs to be repaid. Now, the paper emphasizes that in order to have a soft landing during this reorientation stage, it is very important to have flexible economies in terms of labor markets, product markets, the business environment, in order to allow the production, the resource of production to gradually move to the tradable sector, to the exporting industries, and reduce the high current account deficits. So the question is, emerging Europe is somewhere here. The question is, how is it going to move to this reorientation stage? And the chapter tries to locate actually emerging European countries, where exactly do they stand? What are the speed limits, and have these speed limits been broken? And actually, it's very difficult to come up with an answer. If you believe that emerging European economies are very flexible, then the current account deficits that they have today, they can afford them. They are not really a problem. If you believe that emerging European countries are not very flexible, are rigid, then they are already at the red zone. They have very high current account deficits. Now, what are the policy implications of this analysis? Well, emerging Europe needs to manage the risks of the expansion stage, and given that it is very difficult to know what are the speed limits, it is better to err on the side of caution. And as we see in terms of monetary policy, even if you want to be cautious and to slow down the economy, even if you want to hit the brakes, you cannot always do it. And this is why the role of supervision is very important, to make sure that there are no gaps during this expansion process. And as you saw in the earlier graph, it is very important to have structural reforms that will make the economies much more flexible in order to be able to adjust in the future, to be able to reduce the external imbalances and grow out of their debt. The role of supervisors is extremely important to build buffers and reduce vulnerabilities, and indeed central banks in the region, including in Croatia, have been addressing bank distortions, have been increasing capital requirement, has been moving to risk-based supervision,